Ms. Kim, thanks so much for joining today. I know you're incredibly busy. There's a lot going on, especially in the race. And I know we have a certain amount of time, so I want to sort of dive right into it. But maybe you could just give a short version of your background. I have an understanding of it, but it'd be nice for the audience to get a sense of it.
Sure. Well, my name is Jane Kim. I'm running to be our California Insurance Commissioner, an office which oversees a $3.3 trillion industry, and an industry that is actually doing quite well despite what the mainstream media the narrative might be out there. It is, and we in California are required to have insurance to drive to work or to school, to qualify for a mortgage to buy a first home, to open a business or even a nonprofit of any kind. And so we have to make insurance affordable and available because otherwise we're going to shut everyday Californians out of our economy. A bit about me. I spent 12 years as an elected official here in the city and county of San Francisco as a member of the San Francisco Board of Supervisors and School Board, where I'm really proud to have worked on landmark legislation such as the first $15 minimum wage ordinance in the state, and a revenue measure that has now made San Francisco the only city to make community college tuition free. I'm also really proud to have negotiated the most affordable middle-income housing of any California legislator during my time. After that, my period as an elected, I worked for Senator Bernie Sanders as his political director and also spent 4 years as the California director of Working Families Party, where we're working to build a corporate-free electoral infrastructure to elect candidates from school board to U.S. Congress.
That's great, and it's really interesting, and I think it's incredible and interesting to sort of have a progressive perspective on what's going on in the insurance market, and especially in the California insurance market, because there's so many forces at play, and particularly in property insurance. It's sort of like almost like a laboratory for what's going on in the larger, U.S. economy and global economy. There's, you have wildfire risk, you have a public plan that's struggling, and then you have the whole issue of AI and data centers and demand from there. So, and that all circles back into the possibility of wildfire risk given the utility issue. So, from that perspective, what's the fundamental issue that you want to solve when it comes to the insurance market in California?
Well, this office is incredibly interesting to me. It's one of the most important jobs that you may not have heard of, because it sits at the very interesting intersection of the most important challenges facing California during this time: wealth inequality, economic fairness, and climate disaster. And we can kind of go into all the different ways that insurance plays this interwoven role in our lives. But I mentioned it earlier. We are required to have insurance to participate in the economy in any type of meaningful way. Insurance has this outside say on who gets to build wealth and how much it's going to cost them. So we have to make insurance affordable and available. Otherwise, we're shutting everyday people out of our economy, and we're not building an economy that works for all of us. This office has been incredibly under-leveraged and is very under the radar, but could be a powerful platform for working families and another ally in this movement to make this economy work for everyday people. And so I've been running on one of the more unique platforms of the 11 candidates that ran for this office. I'm really excited that we came in first place, that we're leading +8 statewide. We won in counties that Hilton and Trump won in, Republican candidates. We also won every Southern California county as well as the Bay Area where I am from. And I think what this showed was that our message of running on affordability and making government a champion for everyday people resonated. And everyone knows that the current framework is a systematic failure. The premiums are too high. They're raising our rates. They're canceling our coverage. And even if we have insurance, they fight our claims every step of the way. I've talked to claim adjusters that estimate that anywhere from 1.7 to $3 billion are stolen every year from Californians in the form of claims that are denied, delayed, and underpaid. So there's huge issues around economic fairness that this office is set up to enforce the good laws of California. And there's a lot of work that we can do to combat immense wealth inequality. Insurance is actually considered one of the greatest transfers of wealth from everyday people to big corporations. And as we mentioned, climate disaster. Climate disaster has probably been one of the single largest factor that has changed the insurance framework in this country. We used to have $1 billion storm every 3 to 4 months. We now have one every 3 weeks. And the current insurance framework isn't designed for modern conditions of the catastrophic disasters that are happening across the world. And so I am proposing to not just be the candidate, well, let me take a step back. Many of the candidates that run for this office historically, and also this year, are arguing that they're going to be the best driver for this broken car. That they're going to drive it carefully and slowly and take this car that's falling apart to its destination. I want to fix it. So I'm running on a platform with 3 priorities. One is to introduce a public nonprofit insurance for disaster. This is not my idea. It exists in France and Spain and New Zealand. Japan has a version of it. Second, I want to expand our already existing low-cost nonprofit auto insurance to more Californians. And finally, I want to guarantee healthcare for every child in California. But more than anything, I want to make sure that this industry actually works for us, that this office is a watchdog for consumers and not just a lapdog for corporations.
I want to dig a little bit into that. When you talk about, getting into the role and what your priorities were, and I'm just going to focus on the role of homeowners and catastrophe insurance. And you mentioned it, claims seems to be a big issue, the speed of claims. What are your thoughts on, is that the first thing you're going to try and address as insurance commissioner when you join in, and what are your solutions for that?
Well, let's start with claims. I want to make sure claims are fast and fair. It's the business that we are paying into. Insurance industry, though, they're more institutional investors than they are insurers. Right. Their primary business is getting capital that they then invest in the market, right? That's our premium dollars. Insurance is almost a secondary part of their business. And one of the ways that they are so profitable, besides raising our rates and canceling coverage on the folks that they view as their sickest, or people with pre-existing conditions, whether they're patients or homes or cars, is that they also fight our claims every step of the way. And so again, we see insurance companies deny, delay, underpay, claims that they're contractually obligated to pay when you purchase that policy from that company. And so one of the major aspects of this office as the regulatory oversight of this $1 trillion industry is to make sure that the insurance industry plays by the rules in the state of California. And that means paying out claims quickly and fairly. So one, I want to freeze your coverage when you file a claim. You shouldn't be penalized for using the business that you've been paying decades into. None of us want to be the victim of an illness, a collision, a fire. But when that day comes, we want insurance to be there for us. So I want to freeze your rates when you file a claim. And two, I want them to pay you interest every day they deny, delay, or underpay a valid claim. We have to pay a late fee, or coverage gets canceled on when we're late on our payments. We should equal the playing field or level the playing field.
So how would you sort of deal with the sort of issues around that? Because, as you surely understand that insurance is, as you mentioned, it's institutional investors, it's large sums of money, it's capital coming into California, and they have the ability to pull out. They can withdraw from the market if they feel that the process isn't, according to their calculation, fair. How do you overcome that when you're trying to fix the claims issue?
So that's the current situation. We either let them raise rates or they exit California. And that's not a healthy market. That's a hostage situation. And that is why I'm proposing a public nonprofit insurance program, because we need to alter the game. And if we don't figure out how to raise and increase our leverage and change the factors that are operating, we're never going to have a level playing field for consumers. So a disaster for all insurance program, nonprofit and publicly run, and expanding our already existing low-cost nonprofit auto insurance program. Those are the big ideas. But, there are other things that we can do as a state. We're a state of 40 million residents. I don't believe that insurance truly wants to completely exit out of California's market. I think we need to start acting like the most populous state in this country that we are. One example that I'll give is that insurers actually do want to continue to provide auto insurance. It's incredibly lucrative for this industry. One of the rules that I want to set is that we don't allow insurers to cherry pick which business that they provide. If you provide auto insurance to a zip code, you have to provide home insurance as well.
Great. So maybe beyond that one aspect of it, maybe you can walk me through, obviously your disaster insurance for all is sort of like a corollary to Senator Sanders' Medicare for Medicaid for all. Practically, how do you see that being implemented?
Yeah, so luckily we have models that we can look at around the world, and I talk a lot about New Zealand's model. So New Zealand operates what is considered a single-payer, nonprofit, publicly run disaster insurance program, guaranteed for homeowners, and so insurance still exists. So there's insurance for the garden variety of risks, so burglary, the pipes bursting in your home, the fire caused by the gas stove, would still be insurance that you can buy on the for-profit private market. But public disaster, like fires and floods, this would be risk that you would pay towards the state. And so in New Zealand, you get your insurance on the multi-payer market. The insurer then pay that line item of disaster to the state. So from the consumer's aspect, there's no change from their experience. And then when a disaster strikes and it's been declared by the state pays out the claims. But you still file your claim with your insurer, whether it's AAA, State Farm, or Farmers. But a key aspect of it is this. We claw back a portion of the premiums that we're already spending, and we steward it in public hands. We invest those dollars. So the dollars that we're spending stays with us. We keep the returns. And instead of our returns going to shareholders and CEOs, we actually use a portion of it to plow back into our communities to invest in resiliency and infrastructure and fireproofing and floodproofing. There's only two ways to lower the risk of a portfolio. One is what happens currently. We cancel coverage on the homes that we view the riskiest, the sick homes, the homes with pre-existing condition, like what we see in healthcare. The other way to reduce the risk of portfolio is to actually invest in prevention, and that's what New Zealand is doing. They're actually using a portion of the revenue and investing it in fireproofing and floodproofing, things that actually prevent a fire from taking place. Individual homeowners can do all the home hardening that they can invest in, whatever they can afford, but it's not going to stand up to a wildfire if we're not going to do community-wide resiliency infrastructure work. And I'm the only candidate that is proposing a new revenue stream to help us get there.
I want to get back to that because I have lots of questions. But one thing I wanted to ask, so broadly, how would this be funded? What's the funding structure for a disaster?
The premiums. Exactly the way it works for the private for-profit insurance industry models. They charge premiums that policyholders pay, but instead those premiums would come to the state. It would just be a different entity that would hold our dollars.
And would there be any role for, let's say, the private reinsurance market or the private market in sort of offsetting that risk?
It's possible that the state would buy reinsurance from the private market to share some of that risk, exactly as the private insurance industry does today. I mean, this would all have to be studied to make it a framework that actually works for the state of California. But the idea is that we claw back some of the money we're already spending. And instead of it going to this trillion-dollar industry, we keep some of it in public hands. We invest those dollars. And then the returns from those dollars don't just go to the shareholders. They actually get plowed back into the community in forms of prevention infrastructure spending. We're already spending this money currently. And I'll just give you an example of how much capital the insurance industry accumulates. Travelers Insurance, which is one of the top 10 insurance industries in the country, announced that it made so much money just in the first quarter of 2026 that they had $2.2 billion in excess capital. And what did they do with it? Did they provide discounts to their policyholders or refunds? No, they gave 100% out to their shareholders. Imagine if we could claw back a portion of that and invest it back in our communities in the form of prevention and resiliency. Canada, interestingly, has single-payer auto insurance, publicly run and nonprofit. They're also not allowed to keep excess capital in their reserves. So during COVID, when collisions went down, they provided discounts or refunds rather, to all of their policyholders. My friends in Vancouver got hundreds of dollars during COVID. And they use a portion again of this revenue to invest in improving roads and filling potholes because they know if they make the roads safer that there are less claims to pay out. The for-profit private industry is not incentivized to do this. The incentives are all misaligned. Their incentives are to make as much money as possible. A public nonprofit insurance program would actually be incentivized in investing in prevention, things that make us collectively safer. And it would be funded by premiums.
When you talk to a lot of insurance executives, they'll argue that, the reason they're, withdrawing capacity or that the rate is not adequate to the risk, especially when it comes around wildfire. So how does, and I've seen other states tackle this as well. I mean, I know there are several states that have publicly backed pools, but they're not really charging adequate rate to keep it, somewhat affordable for consumers. How do you address that issue?
Address which issue?
Keeping it affordable, but also having actuarially.
The only way to make insurance affordable and available is to invest in prevention. We have to reduce our collective risk. And the current industry is not incentivized to do that. That's why our rates keep going up, because it is true, risk has risen. I mentioned we used to have $1 billion storm every 3 to 4 months. We now have one every 3 weeks, right? And so the only tool that the for-profit private market has is to raise rates. That's what's happening right now. Our premiums have become so expensive that hundreds of thousands of Californians can't afford it anymore. And I've talked to countless Californians from Tuolumne down to Imperial in California that simply cannot afford home insurance. The only way to make insurance more affordable and more available is to drive down the risk. So we need to create a revenue stream that actually invests in risk prevention, flood-proofing, fireproofing, community-wide resiliency infrastructure. That is why I'm proposing a public nonprofit disaster for all program. I actually think that this is the only solution to creating a more stable marketplace. And it will stabilize the economy for the industry as well, who will continue to provide home insurance coverage for all other things.
Where would the FAIR plan has been its own issue, and it's grown dramatically over the past. Where does the FAIR plan fit into this?
Yeah. So the FAIR plan was initiated in 1968 as a civil rights initiative. It was meant to address redlining and black and brown communities in California that insurers used to refuse to insure. It was meant to be the insurance of last resort. Now you fast forward 40, 50 years and it's become the Wildfire Fund. And it has grown 3x just in the last 5 years. It's grown to over $700 billion. And it was never meant to hold this many homes and properties, as you're probably the direction that we're headed in this question. Quite contrary to the perception, this is not a public program. It's a public mandate, but it's privately run by the insurance industry. It is one of the most secret FAIR plans in the nation. It has a 9-person governing board. We don't know who sits on it. We don't know when they meet. We don't have access to their agenda. Unlike states like even Florida, that's Republican, it is for-profit. And so we have a lot of work that we need to do to reform the FAIR plan. So, but we'll always need, in my mind, an insurance of last resort. But what we need to do is depopulate the FAIR plan from being the Wildfire Fund. And that's why I'm proposing a nonprofit public disaster for all insurance program.
Great. I know we're running on time, but I wanted to, a lot of our listeners, the podcast are very interested in the modeling aspect of risk and how to use models and to fairly price risk and understand it. And one of the issues that California is dealing with is wildfire models, and is developing its own public catastrophe wildfire model. What role should that model play and private models play in your vision for the California market?
Well, we should have one catastrophe model, and we should use it as a guide of where to invest dollars for prevention. And so one of the current issues is that we have multiple models. They're proprietary to each individual private insurer. But I think we should have one map, and it should be created by the state of California. And then we should use this map to guide us in where we invest public dollars to drive down risk. One of the major challenges with growing risk, though, that we just have to address at some point is that risk, as I mentioned, has grown. So the percentage of homeowners that live in wildfire zone has grown by 168% since 2011. So this is just going to continue to grow. You may live in a safe zone today, but you may not in 5 or 10 years. And so at some point, we're going to have to deal with climate disaster. And we're going to have to actually address our dependence on fossil fuel and also the damage and harm that fossil fuel companies have caused to the world. In large part, that is seen now in damage to property. One of the great ironies of this industry today is that the private insurance industry are huge institutional investors of fossil fuel, meaning they invest our dollars in the fossil fuel industry. They're also huge underwriters of the fossil fuel industry that is driving climate disaster, and then they cancel coverage on the homes destroyed by it. In a public nonprofit disaster for all program, we would take premiums and we wouldn't invest it in fossil fuel. And we have to figure out what is the role that fossil fuels need to play in the form of remediation to property owners that have had our assets destroyed in the last couple of decades. But we also have to reduce our dependence and reliance on fossil fuel because the direction that we're moving in is untenable. And again, what I'm excited about this office is that it sits at this very interesting intersection of being able to address wealth inequality, economic fairness, and climate disaster. And I want this office to sit at the table and play a huge role in helping California figure out how we are going to combat these 3 things that are harming our economy and harming our future ability to be a thriving and healthy place for California.
Given all that, and I mentioned at the beginning, one of the issues that California is dealing with, and it seems to be an issue that's coming up in a lot of areas of the country as artificial intelligence is developed, and that capacity for data centers and electricity, it becomes more important. And especially in California, the interaction of the utilities with risk and wildfire. So we spend I myself spend a great deal of time, writing about this. So how do you think about that sort of interplay and the push and pull of wanting to support wildfire risk, but also not, in a way, keeping data center development without killing it altogether? How do you figure that? How do you plan that?
How do I, well, first of all,
Do you think it's an insurance issue at all? I mean, what role
absolutely.
does
First, yeah, absolutely. First, they are wildfire multipliers. There's a higher risk of wildfires as these data centers put even more stress on an aging grid. But they also introduce other categories of risk as well. Pollution, water shortages have significant liability risks, not to manage damaging communities and disrupting local economies. And they can make commercial insurance unstable since clusters of data centers become potentially massive single loss events. So we do have to modernize the current insurance framework to be able to address these different set of conditions.
And how practically, what does that look like? I mean, is it a utility issue into modernizing and hardening the utility companies, or is it curbing AI data center development so it doesn't outrun the risk of wildfire?
I think we have to look at all of that. One, we have to develop an infrastructure that is set up for the wildfire disasters of today, not of 40 years ago. Winds have increased, meaning that, so a spark that starts in a neighborhood today that wouldn't have become a wildfire 40 years ago has a tremendous risk of becoming a fire today because winds have grown and also our summers are lasting longer across the state of California. So we have to both look at modernizing our infrastructure for the conditions of today. And I think we have to ask some very big questions about whether we can handle an increase of data centers and the types of risk that they carry for our communities and whether we can afford it.
Is there an interplay between as utilities and data centers and AI companies develop more? Is there a role where they support insurance or offset the risk of insurance in some way in your mind, or is that not something that's on the table right now?
Offset the risk of insurance?
Mm-hmm.
I'm not
Subsidize
sure
it
about
in some way?
well, I'm not sure how it would subsidize or offset the risk of insurance. I think that AI as a tool can certainly be used to better price risk, to calculate huge amounts of data more quickly. That's one of the tools that we're seeing or benefits that we see with AI today. Certainly in the field of science and medicine and research, we see the benefits of AI. And I'm sure there are ways that we can harness some of that power to help improve risk calculation outcomes. But again, I don't just want to price risk. I actually want to reduce the likelihood of harm actually happening in our communities. And I think that's a big piece that we're missing in today's modern insurance infrastructure. And that is what government is designed to actually address, is to address public risk and to reduce it, to make us all collectively safer. And I just believe that this office should be leveraged to be a thought leader in how we can make our communities safer. That is ultimately what is going to make insurance more affordable and more available, and to make this a thriving economy for all of us.
How do you address, and this is something that's actually come up several times in the past when discussing particularly wildfire, there's almost a collective action issue that comes when talking about mitigation, where one property will be hardened, but there's another property that will not, but that the unhardened property will increase the wildfire risk of the entire community or section. How do you address those sort of collective action issue of all homes hardening? And is that an insurance issue for you?
A public revenue stream which would come from a publicly run nonprofit disaster insurance program. One of the reasons why I'm proposing this is that it would create a public revenue stream of premium dollars that we're already spending, except that we would claw some of that back and invest it back in community-wide resiliency infrastructure. You said it exactly right. A single homeowner in a community doing hardening is not going to stop a wildfire. One, you need a collective action of all homeowners. But two, you have to do defensible space and other types of infrastructure that actually exists outside of the perimeters of a single property owner. So a public program is the only solution to addressing collective action. We need to invest and pool our resources together to combat risk. And so that is why I'm proposing, again, a public nonprofit disaster for all program. We're clawing back some of the money we're already spending and investing it back in us and stewarding it in public hands. But second, we're spending a lot of time talking about how we can pay for the massive harmful consequences of climate change driven by the fossil fuel industry. And we never ask, what can we ask the fossil fuel industry to do, or what can we do to actually prevent the future devolution of climate disaster, which is really reducing our dependence and reliance on fossil fuel. That is ultimately what is going to make us all safer. And we have to have that conversation. And I want the Insurance Commissioner's Office to be at the table to discuss how we reduce our reliance on fossil fuel, how we ask the fossil fuel industry to pay into the harm and damage that they cause the state of California. And then, in the meantime, figure out how we, in the meantime, build infrastructure that will help reduce our risk overall with the current factors that are in place.
Great. Last question for you. You've been really gracious with your time. So everybody's going to ask, and I just know the way investors and insurers think. It's so what are the metrics that you look for? What do you see are metrics of success in the first 6 months, 3 months, year of being insurance commissioner? What do you want to accomplish?
Well, one, I want claims to be paid more quickly and more fairly. I want to make sure that this business, that this department gets to license, who gets to do business in the state of California, plays by the rules and plays fairly. And a big part of that is making sure that they are doing the business that they're in, which is paying out claims fairly and faster when disaster strikes. Two, I really want to build a big stakeholder table with state legislatures, with consumers, with the industry, to figure out how we can modernize the current insurance framework to actually work for today's condition of climate disaster and increased risk. And moving us towards a solution that makes insurance more affordable and more available for all.
Great. Thanks so much for your time. It's been incredibly helpful. Thank you.
Thank you, Chris. Thank you for having me.